What's going on, guys? Welcome to the new Equity Connections podcast. Your host, Ian Starkey. Today, I'm hanging out with my good friend, Jeff Guo again. So I wanted to bring Jeff on the show again because I love having him. He's a great dude. We're doing a lot of things together right now. But specifically today, we want to talk about LP partnerships. So what it looks like to be a limited partner in a syndication. Jeff himself has been a limited partner in many deals before he jumped over to the general partnership side. So just want to kind of pick his brain a bit, learn what it's like, what it's been like for him, and kind of let him share for all you who don't know and all you who are kind of on the fence about investing in a syndication versus doing your own deal, kind of see what it looks like as a limited passive investor. So Jeff, thanks for coming on, brother. Take it away.
Yeah, absolutely. Thank you for having me, Ian. Appreciate it. So let me start by just sharing with the audience a bit about my background and kind of transition into the path that I took. And there are, 1,000 paths people can get to where they want to be, but I just want to share mine and hopefully can, bring some idea for your audience. So I love real estate. I know I want to do real estate ever before I got into college. So I got my degree from college in real estate and finance. Love numbers. And after college, I worked for a public traded REIT, real estate investment trust, and I did primarily asset management of a portfolio of roughly $350 million. Get to learn from the big boys of how they get to manage a pretty sizable institution grade portfolio from the asset management level, and also helped close on a few acquisitions north of about 120, $130 million. So get to see both the acquisition and also the asset management side of the business. So that's on the equity side. And a few years later, went and worked on the debt side of the business, which is a completely different mindset from the equity, right? Equity is more about the upside, and the debt side is all about downside protection. What are the 25 risks that most human beings cannot even identify but do exist? So work for CMBS, it's called special servicer. CMBS is short for commercial mortgage-backed security, where it's a form of financing. And once the property cannot meet its debt obligation, the lender would foreclose on those distressed assets, foreclose on it, and come to our company. And what we will do as the asset manager is we'll receive those property, and it can be anywhere between 0% occupied to 20, 30% occupied, just distressed property that was bought back in 2004, 2005 with some pretty crazy underwriting assumptions. And what we will do is we'll turn around those assets within usually 24 to 36 months period. Probably never to its glorious days back in the days, but to 50% occupied to sometimes 90% occupied to sell it, right? So I get to see really the downside, how ugly this business can get, because some shopping centers might be worth $12 million when they bought it with all the gross rosy assumptions, and now they're worth literally $2 million, $1.52 million. So I get to see not one, not two, but like 30, 35 of them within the time I was there. So get to see a lot of dead bodies, as people call it. So I get to understand really what not only the upside of the business, but in my opinion, even more importantly, the downside of the business, to see how bad it can be. Because most of those landlords and sponsors, guess what? They're in a bankruptcy court, at the time. It's not pretty. So after that, get to make some good connection with my colleagues, and one by one, they left and do their own thing. And hey, Jeff, I got this deal put together. So I understand their thinking process. I understand the way that they mitigate their risks of the deal. And hey, if you want to have some money, why don't you invest in this deal and that deal? So, I'll look at a deal, look at the people. So that's really when I started investing, passively into, first of all, shopping center, because that was my background, and then some hotels, and then multifamily. So, long story short, right now I've invested passively probably about 12-ish, give and take. I've got about 12K once last year, and across, a few different asset classes passively.
Awesome. So, see, you saw the good, the bad, and the ugly while working for that REIT. And for those who don't understand, those who don't know, my listeners, so commercial property is deemed commercial because it's income producing. So, a commercial property could be made with quartz countertops, all brick, all stone exterior. It could have the best, gorgeous finishes, but if that property doesn't have a tenant in it, if that property is not producing income, then, say you spent $10 million building this building, if it's not making money, it's not worth a dime. So, whenever Jeff was talking about how these properties, at their peak were worth about 20 million, and now their value came down to 2 million, their value dropped so low because whoever the manager, whoever the owner was, whether if it's the owner, whether it's the management group, whoever is actually running the show and running that asset, they either dropped the ball and they couldn't lease it up, couldn't get paying tenants. The tenants that were in there weren't paying and were probably destroying the property. So that's why valuations in commercial real estate can skyrocket and they can drop, because the valuation is solely based on how much money this property makes. And different asset classes will trade at different cap rates. So the cap rate is the net operating income divided by the purchase price. Most markets will have a kind of a base range of a cap rate based on the market, based on the asset class. So it all depends on how much money it makes. If it doesn't make money in commercial, it does not make sense. So
Absolutely.
yeah.
100%. You got it right. It's all income produced. It's all income based and have little to do with most other variables. It's all based on the income. Absolutely.
Absolutely. So you know, it's like your whole team, they kind of joined this REIT, and now you left to start being general partner. So you all kind of had the same goal, which is awesome. You know, join with the big boys, learn the game. Once you got some money in your pocket, once you got some knowledge, once you have the experience, all right, let me go start making the big bucks on my own. Let me hop out of the salary position and go into a entrepreneurial position where there's no ceiling.
Yep.
So what did that look like for you?
No, I love that, Ian. And what's been really rewarding is that some of my colleagues or some of my previous managers slash my bosses, right? Some of them become our, passive investors, which, it's not just to take their money, but it's also just a confirmation. Oh, you know what? I believe in Jeff's project. I believe in, who Jeff is. So that for me, just looking back, it's been pretty humbling and, great experience. But I mean, when it comes to a path, I think the path that I took is I went from kind of like the institutional level and kind of work my way to do my own thing. But as a lot of people, right, they start with a single family space, a multifamily. They're working their way, to the bigger syndication too. I think every path worked as long as you learn the stuff. So what I can bring to the table is to have that institutional mindset plus the mitigation perspective. And for someone who's coming from a single family perspective, right, they know how to negotiate the lease, the deal, how to work with the contractor, which is also very, very valuable as well, and I just love the path that I took, and I would not have chosen any other way. But also at the same time, I know many people are doing some crazy successful things from, many other paths as well.
Absolutely. And yeah, let's dive in. Let's dive into it. So you said you got, was it 13 K1s last year?
12, 13, something like that. I kind of lose track a little bit. Yeah.
So what is a K1? What does that mean?
Sure. So K1 is a text document that is sent out to all the limited partners and also general partners at the end of the tax season, usually sometime in January and February, that outlines, what percentage of the deal that you own and what's your capital contribution. And the number one thing I'll be looking at whenever I get a K1 that's usually 50 pages is the one thing on page one is how much net income that the property has produced. And usually it's shown up as a loss. The bigger the loss, the more excited I am, because even though I'm receiving cash flow from those property, but due to depreciation, I was out of 12 K1s, I also probably 10 or 11 have a loss, sometimes pretty big due to depreciation. And guess what? I get to use a portion of that loss to offset my other income, and I pay very, if any, taxes because of that. So
now, how is that possible that you're literally receiving paychecks, you're receiving cash flow, but on the tax on the K1, it's showing a loss from the depreciation? How does that work?
I know it's like a magical, right? The first one or two deals I invested in, I thought, oh, I'm getting 8% cash on cash return. So for simple math, let's say if I put in, $10,000, 8% of that, $800, I'm going to be paying 25% of that $800. But when I receive that, not only I'm not paying a single penny of that $800 that I'm receiving, which is cash in my bank account, but also I get to use that to offset some of that other income. That's the beauty part of real estate, right? The magic word is, depreciation. And that's why I love real estate. That's why you love real estate. That's why people love real estate, because not only are you getting money into your pocket, but also you don't hardly pay any taxes on it. So,
mm-hmm. And with depreciating assets, is there a specific way you guys are going about capturing this depreciation? How are they capturing that?
Sure. So in normal cases, if you don't do anything to the depreciation, the IRS normally give you, 27.5 years or 39 years, depending on residential versus commercial properties. What does that mean? It means that if the property bought it for $1 million minus the cost of the land, call it $200,000. So the actual building is worth $800,000. The IRS lets you depreciate that number, $800,000 divided by 27.5 years. So each year you get to depreciate a small portion of it. So for simple math, call it $30,000 a year. But there's a thing called cost aggregation where you can work with an engineer to say, look, this building is the whole building might be takes 27.5 years to depreciate, but we've got a refrigerator, we've got a floor, we've got a kitchen. Guess what? They're going to go bad after 5 years or 10 years, right? So you get to accelerate a portion of that $800,000 to 5 years. Sometimes, they have a bonus depreciation came up a few years ago that you can depreciate a bunch of them in year one. So what does that mean? Out of $800,000 of the building value, potentially you can depreciate, and I've seen some crazy as 30, 40, 50% of that. So $400,000 can become a tax loss on your K1. Guess what? If you're making $400,000 from a doctor's job, from a lawyer's, from other active income, you get to use that to offset that. So it's just a beautiful thing about real estate.
Absolutely. And that's my big thing is, most of the investors that I'm connecting with and I have in my circle right now are high income earners, doctors, medical sales professionals, lawyers, people who make a lot of money in their business or their 1099 role. The beauty of making money, there's also a catch, is now the government's like, oh, you made $500,000 this year. Well, you're in this tax bracket, how are you going to show us that you're actually, this is all profit. You have to pay tax on your profit. But if you invest that money, just like Jeff did, into a real estate asset that has a high amount of depreciation that you can capture and you can realize within the first, couple of years or realize during your holding period, then okay, yeah, you made a lot of money from your business, but you invested all that money into this asset, which now you own a lot of shares of. Well, this asset took a loss for, if not all, majority of your income. So kind of balances out.
Yeah, no, absolutely. I mean, it's a beautiful thing. I think when we talk about tax and IRS, right, most people are like, oh my gosh, that's a document of, I don't know, 8,000 pages. But very few people actually know out of 8,000 pages, probably 50 pages of that is written to tell people what taxes that you should pay, this and that. The rest of it, 99% of it, is actually written for people like you and me, Ian, and hopefully some of your listeners, to be legally taken advantage of the tax loophole or tax credit, this and that, to reduce taxes, right? So 99% of the IRS documents is actually written to help us legally reduce taxes. Once that mindset starts switching, guess what? I bought one of those 1,000-page tax book. I started reading through it. It's like it's great, and tax is a beautiful thing. And, obviously listeners definitely want to talk to, their CPA about, because, it's, sometimes depending on people's tax situation, you might need to be a thing called, real estate professional and this and that. So there's a few more layers that people need to go through in order to fully take advantage of, the depreciation, but it's not rocket science, and everyone can figure it out. So
Absolutely. And no, thank you. That's really insightful. Could you and also let's actually paint the picture of what it looks like being an LP, being a passive investor in a deal. So, let's say Jeff, I call you up, I say, hey Jeff, I got this deal, we're gonna buy it. We're raising some capital right now. Take a look at it. Let me know what you think. What would you do from there?
Sure, absolutely. So for me, there will be a few layers that I'll be looking at from a deal. Before you even look at a deal, right? I'll ask myself, who's that person? How do I know that person? What's that person's track record, integrity, and all that stuff, right? So in my case, most of the deals that I have invested in the past came from my colleagues and then, other people I met in the network who's got a great reputation. So before I'll even looking at the actual deals, the asset class, the return, I'll look at, okay, who that person is. And sometimes I might not know that person, or that person might not have the best reputation. Guess what? I'm not even going to look at the deals, right? So the
Mhm.
first layer I look at is, who is that person? And then, okay, so if I give the green light to the person, then the second layer that I'll be looking at is the actual property, right? I'll do my own underwriting, risk analysis, what's the upside, what's the downside, because 90% of deals out there will fit into a box in terms of the IRR and cash on cash return. Oh, you've got 16% IRR, 5-year hold, 8% cash on cash return. But based on the input assumptions that you use, the exit cap rate and all that stuff, because that number the numbers is only as good as the projection, right? Then
Mhm.
I'll dig really deep into the assumption that's used, and how realistic it is. And the third layer I do is I'll do a quick calculation in terms of what is the final stabilized value, call it $100, and I'll look at how much is the all-in cost, what's the purchase price, what's the renovation cost, call it $70. So I do some quick math. For me, for the deal that I put together and for the deal that I invested in, I would not invest in a deal if it does not have that at least 70% or below ratio, meaning, and you have at least a 30% equity going in from day one, so that
Mhm.
if things were to go south, which it always would in some way, shape, or form, I know I'll have 30% equity cushion to protect my capital, to protect my investors' capital.
Mhm. And what is that 30% equity cushion? What does that mean to you? If you could elaborate on that more.
Sure, absolutely. So a lot of people nowadays, because how hard the market is, are paying what we so-called retail price, right?
Mhm.
So if the building is worth $100, people will pay $95, $96 to it. So the equity cushion in that case is $45. What does that mean? If the market shifted, instead of the building worth $100, let's say if it's worth only $90, guess what? You'll be losing $6 off the deal, right? So the bigger that gap is, the safer it is for your own capital. So the rule of thumb that I use is, okay, if the building can be worth $100, I need to be at all in, meaning my purchase price plus my renovation cost all in, for less than $70. So if the market shifted, instead of worth 100, the thing is worth $85. Guess what? I can still sell the building at $85 minus my all-in cost of $70. I can still make $15 instead of losing money. So that's what I meant, is that gap between the two numbers.
Absolutely, absolutely. So basically, and you're explaining it very well, but for those who aren't following, basically what Jeff means is that he's never going to buy something at market price, and that's we're working on right now. We're working on some properties right now where we're getting very surgical, very intimate with the numbers in the market to understand, okay, at the price we're paying, at the renovations and the money that we're going to spend, renovating, improving a property, because most of the properties we look at are value add. They're usually distressed, underperforming assets. Once we're all in on purchase, renovations, capex, where is our projected value compared to market, compared to other properties on the market? So, if our projected value, if we're buying a property for 40 cents and we're going to spend 20 cents, renovating it and bringing it up to par, which is projecting what it'll be stabilized once it's fully occupied, once it's filled with tenants, they're all paying rent. Once we spent the money, once we spent 60 cents, if we're projecting that the property is going to be worth $1, then we basically bought this property and we're all of our equity combined in the property is 60 cents. Property's worth $1. So we got 40 cents of immediate profit if we want to sell it, or 40 cents of like you said, cushion if the market downturns or if something happens. So,
Cool.
if in coincidence, if we're looking at buying a property and we're buying it for 80 cents and it's going to cost us 30 cents to renovate it and bring it up to par, and the value is only $1, we're looking at it like, okay, we're gonna be all in for $1.10. Markets do appreciate, and most markets will continue to improve, but if we're gonna be all in for $1.10 and it's compared to other products, it's only worth $1, it's probably something we're gonna pass on, because that's kind of a risky investment. Because then if you're all in for more than the value when you buy the property, or more than the comparable value to other products in the market, you're you're kind of just betting on appreciation in order to make money. And let's look at that. So if we, because there are investors who do that. There are investors who buy properties at market value. There's some big time marketers, big time influencers that do that, and they have a lot of AUM. They have a lot of assets under management, but where are they making money there? I mean, are they making money on depreciation? Are they just making money eventually if they're able to sell it? Where could someone make money in that
Sure.
case?
Well, I mean, just like there are 10 different, 100 different paths to get into real estate, right? I mean, there are 10 different ways to buy property, right? So the
Hmm.
one that I mentioned, Ian, is just, it's just my way, my
Hmm.
business partner's way of buying property. But at the same time, that's not the only way to buy properties, right? And like you said, there are people who's buying property at close, if not exceeding the property existing value for something that's worth $10 million. They're paying $12 million for it and hoping the thing will be worth $20 million 3 years from now. Not to say that's not going to happen, but if the market turns, that's how, back in the days when I was the asset manager for the CMBS shop, some of the property that came back is worth, they bought it for 25, 35, $45 million. We're talking about some pretty, high level people. And guess what? Property gets foreclosed, investor lose all the principals. I'm not saying that's happening to every single person, but to answer your question, right? How do they make money? Depreciation is definitely a big one. And two is I've seen some sponsors out there who's charging, I don't know, the investors 5 different layers of fees: acquisition fee, asset management fee, loan guarantee fee, project management fee, all sorts of fees. What does that mean, right? What that means is even if the project itself is not performing, the sponsor will still be extremely wealthy from the fees that they charge, even 1 or 2%, 2 or 3%, but off of AUM of or asset under management of $100 million, that add up pretty quickly. But guess what? The investor is the one who's going to suffer. So that's what
Absolutely.
I have seen sometimes.
Yeah, no, and like you said, there's a lot of ways to skin a cat, and that's also another layer of due diligence that an investor should do. How is your sponsor structuring the deal? How are they getting paid? Where are their values? Where's their motivation? Personally, whenever we do deals, most times we will charge an acquisition fee because it takes time, it takes money to put a deal like this together. And usually we're out a lot more cost than we even anticipate when we're putting a deal together. So an acquisition fee, we're able to recoup our money. Depending on the deal, depending on the nature of it, sometimes we'll do an asset management, sometimes we won't. Usually I'd like not to, just so we're all making money off the equity, we're all making money off the cash flow. But sometimes we will if we have to shorten our equity. Sometimes we'll do a small asset management, but typically we're very minimal on fees because you know like and Jeff would agree because Jeff, what kind of fees do you usually charge your investors?
Very minimal,
Yeah.
for, I mean, the last few deals that we did together, we just charge an acquisition fee. We don't, nothing else.
Mhm.
Some of the development stuff, I think instead of charging an acquisition fee, we just charge a construction management fee so that people who's doing all the work will be compensated for their time. Again, it's nothing crazy, but we just try to keep our fee as little as possible. And our mindset is otherwise we'll become a real estate, selling houses, right? Instead of making deals happen, right? It's cash flows, the equity that we really care about, not the fees. So.
Mhm. Absolutely. And the thing that why I'm spending some time talking about fees is, fees are something that are charged regardless of what the property is doing. If the property is 100% occupied, making money, we're not only covering our loan balance, but we're also making a lot of money, it's great. But if it's not making money and we're just barely making our loan balance, fees are still fees. You still have to pay the fee. The fee is above the bottom line. So, I tell investors to be wary, be cautious, and really understand the fee structure, and understand how that sponsor is putting a deal together, and make sure that your values align. Are your values both to have an income producing asset that's going to make you both a lot of money in the long term, or is it a sponsor who is driving a Bentley, driving a Lambo, living on the lake, has a lot of expenses, and he's got to cover his own lifestyle, and he doesn't care what the property does. So,
Yep.
yeah.
I mean, fortunately, I know people who knows people who's like that. Oh, I'm going to buy at least a $5 million property. It has to be $5 million. I asked him why. He said, oh, 2%, 3% acquisition fee. That means $150,000 checks. After 4 to 5 deals, the person might be making close to $1 million, but the property itself are bought at such a high valuation that they're not doing well right now. So it's just unfortunate, kind of like the ugly reality of this business sometimes. So.
Yeah, and it can turn into kind of a brokerage as well. I consider sponsors like that more more so on a broker focus, because brokers, because I'm a licensed agent myself. I list homes. I sometimes will help buyers find homes. For the most part, most most of my focus is into listings. And when I list a property, we spend money on marketing, we spend time negotiating, and we're working for a fee. We're working for that commission. If we sell the home, we get paid. If we don't sell the home, we don't get paid. So it's the same thing with these kind of properties. Are they focused on investing in a property, or are they focused on just getting paid to acquire a property?
Yep.
And I think that statement right there is very big. Are you focused on investing, or are you focused on just getting paid? So,
exactly.
Key points.
It's huge. It is huge, right? And also from a long-term perspective for the fees is that it's nice to get some cash in, right? But guess what? The moment that you stop doing deals is when the fee stops coming in. Versus equity, guess what? You put a good deal together, you get a piece of the equity, and the cash flow is going to come in, right? And that's what we want, the residual income, right? Not transactional income, right? And there's a difference between the two. That's why we're so big on creating enough equity for everyone involved, including the investors, as opposed to fees, right? Because fee is a one-time revenue versus equity is revenue that can be generated for the rest of our lives. So.
Absolutely. And so as an investor, just to recap, so when you get a call, when you get pitched a deal, or you hear about someone who's doing this kind of stuff, so usually your first step, and correct me if I'm wrong, so your first step is you want to look at the sponsor, you want to look at the operator.
Yep.
If the operator checks out, dive deeper. If you hear some crazy things about the operator, or you just don't like the way they do things, checks off.
That's right.
And then after that, look at the deal. If the deal checks out, what, or take it away from here. So after the sponsor, then you look at the deal.
Sure. After sponsor, and oftentimes, the sponsor might not pass my first screening, so I don't even look at the deal. But let's say if the sponsor does check off, then I'll look at the deals. And the deal need to have a very, very conservative, underwriting assumption. So I'll encourage your listener, right? Whenever, your listeners get a deal, look at it, what are the rent assumption? What are the exit cap rates assumption? What are the rent growth assumption? What are CapEx assumptions, right? Because, we can make the most ugly deal look like, the best deal in the world by twisting some of those assumptions by just a little bit. So look at all those assumptions. And if the assumption is conservative enough, then I'll look at kind of what we talk about, the ARV stuff. And then if it checks all three, which does not happen often, by the way, probably, I don't know what the percentage is, but I get quite a few deals offered to me to invest, and I'll invest a very, very small percentage of it. But if it checks off all three layers, then, I'll consider investing money into it.
Mm-hmm. And then once you just, once all your boxes are checked to invest money as a passive investor, what's next?
So once you invest the money, just sit back and relax. That's one thing I love about, investing passively, is that you get to collect, as we call it, the mailbox checks, usually once a quarter, at a return that is predetermined by the sponsor, obviously based upon the project performance. And each quarter I'll go to my PO box and collect a check and deposit into my bank account. And at the end of the tax season, I'll get a K1 I'll see how much taxable loss that I have, as we talked about earlier, and just sit back and relax. And that's one thing I love putting deals together, as you know, Ian, and being the more active role. But at the same time, I love investing passively because the money, my capital is working for me to bring in more capital, right? So like a soldier is going out and bringing more soldiers back home. So I love investing passively as well.
Absolutely, because I think there's a lot of people, if not every person on this earth, that makes some money, wants to invest in real estate. But I think a lot of them, shy, and I've had family members that make good money, that shy away from real estate because they're like, I don't want to be a landlord. I don't want to deal with tenants. I don't want to deal with repairs. I don't want to deal with maintenance. I would invest in real estate, but I don't want to deal with all that. So I'm just going to keep putting my money in my 401k, doing this, doing that. And, I'm trying to tell them, like, hey, wait, like you can invest in real estate. You can own property and not have to deal with any of that.
Absolutely. That's the beauty part of passive investing. I don't care what toilet needs to be fixed. I don't care what roof needs to be replaced. It's all done by the sponsor. And that's why the sponsor are being compensated for their time and effort, and also their risk of, signing on a loan, right? It's a pretty big risk people are signing up on. If the loan is $5 million, the person will guarantee it. Anything were to go wrong, as the passive investor, at the most, we're going to lose, the $50,000 that we put into the deal. But as a sponsor, they'll be on the hook for $5 million, right? So their downside risk is huge. But as the investor, if I pick the right sponsor, pick the right project, I've got a pretty good upside, and my downside risk is only to the extent of the capital that I invest into the deal. So,
Absolutely. So if you're interested in getting involved in real estate, contact Jeff, contact myself. This is what we do. We buy deals. We focus on apartments and RV parks, more so starting to focus on RV parks because these things are cash cows. They're incredible. I mean, Jeff, what's been your recent acquisitions as a general partner? Has it been more RVs or more apartments?
It's been more RVs just because it's less competition at this point, and we're anticipating more institutional players to come into this space, which will drive down the cap rate and therefore increase the valuation. So it's been more RVs in the last few deals that we did, and a few mobile home parks, but it's a mixture of mobile home parks and RVs. But last few deals has been more RVs.
Absolutely. Well, dude, thank you so much for coming back on. I'll drop Jeff's contact in the comments if you want to get in touch with Jeff. And yeah, thanks for watching. Appreciate it.
Absolutely. Thank you for having me on. Yeah, appreciate it, man.